Alright, welcome guys, welcome to my YouTube channel, and once again we are here to discuss something. As I said earlier when I did my session trading today, we discussed the thesis of what today's action might be. And so I'm here to discuss what futures are. To some of you, as some of you some of my subscribers may not know what the futures market is, and so I'm gonna make a simple explanation, and I'm gonna make this as simple as possible so everyone can understand. But before we get into it, I want to talk about something. I want to talk about the idea that we spoke of on my session. So when we were at open, we talked about overall this idea, the idea of the Nasdaq pushing up from this point, from the 160s. We were somewhere around here. If you want to see, I will leave the video somewhere up here. It will pop up by the end and you can see it. So we discussed, even before it happened, we discussed the idea of pushing up to the top of the hourly range. And so basically what happened is, at some point I said we push to the pivot, we reject, we get an opportunity somewhere here, we push, and another opportunity would be to retrace into the pivot, pull back into the pivot, retest the pivot, retest the 240s, and then pull back up, go for a continuation. And guess what happened? We got exactly what we wanted, like on the dot. The price came back, tested the 240s, and continued higher. Continued to literally the next pivot, up there to 361s. So basically from this pivot, we ripped another, basically 123 points. And now look at what's happening now. We are retesting the 300s. Look at this. Look what's happening. We rejected at the 300s several times. We rejected it like, let's put a line here. We rejected it like once, twice, 3 times, 4 times, before essentially breaking out, retesting what was previous resistance, what 20,300 was a price where a lot of sellers stepped in. So what we have done is we pushed through, we came back, and we bought 20,300, and then we continue to push higher. And look what's happening now. We are retesting, and currently retested 20,300, and basically it wants to push higher. Look at this mini breakout opportunity, right? Now, what are futures? That's what I wanted to say. What are futures? The futures market is basically the futures market is made from 2 participants. Number 1 is the hedgers, and number 2 is the speculators. Now the hedgers, to put it very simply, a hedger means you have 2 accounts, and in one of the accounts you go long and in the other you go short. Now the speculators are the traders who buy and sell futures with the goal of profiting from price movements. They do not intend to actually own the underlying asset, but aim to make money by betting on price ranges. So yes, we are day traders and we speculate, meaning that we can make money both down and also up. While an investor could only make money if it was going up. Right? But we're not here to invest. We're here to make money from, there's a lot more liquidity making money from falling price movements, rising price movements. Now the margin requirements for a futures contract is, the futures trading requires a margin, which is a percentage of the contract's value, that the trader must deposit with their broker. This margin acts as a good faith deposit to ensure both sides fulfill the contract. Margins are relatively low compared to the contract's full value, which gives futures trading its leverage nature. Now be careful, because the futures market is extremely leveraged. And I will tell you right now that futures are highly leveraged, meaning traders can control a large contract with a relatively small amount of money. While leverage amplifies potential profits, it also increases risk. If the market moves against the trader, losses can exceed the initial margin requirements, thus causing you to do what's called busting your account. Now let me give you an example of how the Nasdaq works. So on my broker you saw today, I'm afraid I'm not logged in. On my broker you saw that basically they were in units. So my broker had units of 1. Thing is, one futures contract on the Nasdaq equals with $20 per point, right? So $20 per point. So which means that if you buy or sell, if you buy or sell one contract on the Nasdaq, it means you will be making or losing $20 per point, right? Per point, meaning, so what does it mean per point? Well, each time the Nasdaq makes a dollar move, such as from the 309s to the 3010s, you make or lose essentially $20. Now, if you add 2 contracts, right? You add 2 instead of 20, you now have upped the leverage, meaning that instead of 20, you now have $40. So $40 per point. You understand? And the more, it goes from 20 to $20. So the more contracts you add, the more leverage and the more risk you will put on. Now, if I were to go on my trading broker and say I didn't want to buy a full contract, I could have bought what's called a micro contract. So a standard contract is called a mini contract. So it's a standard mini contract. You know what it is on the Nasdaq is a $20 difference per point. $20 fluctuation from your balance per point, right? So every time the Nasdaq makes a move, you make or lose $20. Now, let's say I wanted to buy a fraction of that. Let's say I didn't want a 20 times leverage, because that is essentially a 20 times leverage. Let's say I wanted to buy less, so less leveraged. Now, you saw me in my previous sessions that I posted on YouTube that I bought less contracts. I didn't make as much money, but I bought less leveraged contracts, which are the micros. The micros function this way. So, one mini equals $20 per point move, right? But one micro equals $2 per point. So essentially a micro contract is a tenth of one standard contract. 10 micros equal, with a single mini. So 10 micros, 10 of these equal a single mini. I hope you understand it. So keep in mind that that's why we're traders, to analyze the risk and basically carefully calculate our trades. And I explained today in multiple sessions that in order to make money, you need to lose less than you make. And those are basically the rules. I'll delete this probably later. So let's say that personally you bought here, right? You bought at this place, and let's say you bought at the 310s. 310s. You put your stop at the recent low, which means a 24-point stop, and you say you target the 70s up there. So that's a 60-point move. Now per standard contract, let's say you bought a standard contract on the Nasdaq. A 25-point loss means that you risk $500 in order to make 1,440. So this is a 2-to-6 risk to reward ratio. Now, depending on your account size, $500 might not be the best because some people don't have that type of equity. But let's say you bought 2 micros, right? For instance, you bought 2 micros and you had the same scenario play out, right? Now 2 micros mean you would make $4 per price movement, right? Per dollar, up or down, you would make or lose $4. Now you risk at this point, so you buy 2 micros and there's a 25-point stop. You risk $50 instead of $500 because you bought less. You basically went down on leverage, and you stand to make around $228 for a risk of, actually apologize, for a risk of $100. My bad. I actually calculated the amount for 1 micro instead of 2 micros. So 2 micros mean $4 movement, and you risk 100 to make 228, which is not bad. And this is the essence of trading, is to make more than you win. Now, if you want to know more, just go to Google and come to the CME Futures group, CME group, or just type it in cmegroup.com, and you will see, and go to the markets. Right, you go to the markets and there it is. You have corn, you have soybean, you have WTI crude oil, natural gas, S&P 500, and the E-mini Nasdaq 100. Euro, Forex, 10-year T-note, gold, copper, all products. Cryptocurrencies, agriculture, energy, equity index, Forex, metals, options, and all of those. As you can see, if we click on the Nasdaq, the E-mini Nasdaq, and we go and we scroll down, the contract unit is basically 20 times per dollar. So it moves up or down. The standard contract will make you $20 or lose you $20, depend what you did. The S&P 500, however, is a bit with a higher leverage. It is $50 per point. Now, if you go to the S&P 500, which is right here, the S&P 500 definitely has more volume than the Nasdaq, but it is less volatile. The Nasdaq is way more volatile in terms of leverage and all. So that is why the leverage is only 20 times, as opposed to the S&P, which has a 50 times leverage per standard contract. So essentially, it depends on your style. So if you want something that moves slower and is not as aggressive, then probably the S&P 500 is for you. But if you want something that moves fast and you want something volatile and a bit more crazy and that has a little bit more opportunity, then I would say the Nasdaq is for you. Now the goal when trading futures is to pick a single instrument and trade that for the rest of your life. I picked personally the Nasdaq. So every day, every morning, I will show you, every day, every afternoon, I will show me trading the Nasdaq. The S&P 500, I don't trade it a lot, but I can give you some insights of, because based on the S&P's moves, sometimes the Nasdaq will follow what the S&P is doing and vice versa. The S&P will follow what the Nasdaq is doing. So let's take something in consideration. All things considered, if you're really serious about making money, you'll get yourself into futures, because futures is a market that not only has high leverage but also has a lot of liquidity and a lot of volume. And there are several instruments that you can use to make a lot of money. And sometimes to make money, you don't need to trade a full-sized contract. You don't need to trade 2-3 contracts, like full minis. You can trade 2, maybe 3 micros, just the way I did on my last 2 sessions, and still make a lot of money. So I'd say, I mean, can you trade options? Can you trade crypto? Sure. But if you really want something sustainable, something that really gets you in the flow of making money, then futures, I believe that futures is for you. And in a bit, I will also make a video about what prop firms are and how you can also get funded using a prop firm without risking your capital, only with a monthly membership. So stay tuned for that, because I will be posting this in a bit, and I will explain the current prop firm that I use and why I use it, what are the benefits, and I'll walk you through its, how can I say, the pros and cons, right? I'll walk you through it and you decide if you want to sign up with them or not. By the way, do not sign up with the prop firm with your last bread money. So make sure you have something, and if you're really, really serious, sign up with them, give it a try, and let's make a change. Let's change our entire financial lives. So I'll see you guys in the next video. Hope you understand a little bit. Remember, if you want to know more, go to cme.com markets and look for it there. And you'll see everything you need to know. Where it is, how it is. And by the way, real quick before I end the video, my usual strategy platform is TradingView. So go to tradingview.com, right? Just go here and type tradingview.com. Right, tradingview.com, and then you can also download the desktop app right here. Now, what this will do, if you want to access the live data of the Nasdaq, you will have to pay around $7, but you will need the essential plan, meaning if you're gonna go to the essential plan, it will only cost you about $24 to $25 a month. So the live data plus the access to double charts, which means you have one here, one here, you have an instrument here and one here, it will cost you about 20 bucks. So per month you'll be paying $24, so that's already $24. So this is the platform, the number one platform. Don't use another, use this one. This is the number one platform to use for charting and to develop your strategy. This is where I have my whole entire strategy. Now in my next video, I will explain the broker I use, why I use it, and the prop firms. So stay tuned for that. I will see you in the next one.